All right, welcome to chapter 2, using T accounts. First of all, we're going to talk about that accounting equation, assets equals liabilities plus equity, and how in the heck it relates to these things called T accounts. Again, we're kind of slowly moving into a position where we will be making entries and transactions in an accounting system. We're kind of getting our feet wet, just kind of getting a little bit deeper into the rivers, so to speak, of the accounting transaction world. All right. Identify the debit and credit side, terms that maybe we've heard of before and maybe we have different understanding of. The increase and decrease side and the balance side of various accounts. So understand that some accounts have a natural balance of one side, some have a natural balance of another. So we'll call it the normal or natural balance side. Okay? Restate and apply the true rules that associate with the increase side of an account. Ooh, what's that? All right. Now we have some tools in our tool belt. We've been talking about the accounting equation, assets equals liabilities plus equity. We've been classifying those accounts, recalculating what balances are after each transaction. So we've had a lot of practice in that area, but now we're going to throw in this concept of T accounts. And I'll just say, from a professional standpoint, having been in industry for 20 years, the beauty of T accounts is no matter how complex things get in your accounting world, if you pull out a T account and start jotting in what's going on, it'll help make sense of a lot of noise in your accounting system. I remember we were having a problem with inventory with my job at Seneca. We pulled out a T account, like, okay, what's going on here? Why is this so weird? And it helped us at least begin to get a grasp on what had happened in that account. All right, there's T accounts. Okay, so the accounting equation, assets equals liabilities plus owner's equity. We've been hammering this pretty good. Assets is the left side of our accounting equation. Liabilities plus owner's equity is the right side. Assets is what we own. Liabilities is what we owe. And what's left over is essentially the owner's claim to those assets, called owner's equity. Because either our creditors have a claim to our assets or we do. That's kind of what it comes down to on the right side. Left side, right side. I'm supposed to be using my notes, right? Then we throw in this big T in here. Okay? T. And now we're talking about using T accounts to explain, like, that we're going to throw a T in here. And for the asset side, the increase is going to be the left side. For liabilities and owner's equity, the increase is going to be the right side. It might be a little bit premature with my T, though. We'll see. Okay? So accounts, a record summarizing all the information, is called an account. All right? The accounting device used to analyze transactions, like I said, T accounts, no matter how complex it gets, you can put it into a T account, try to figure it out. Debit means an amount recorded on the left side of an account. Debit side means the left side. Now, I realize we've been thinking about different things like debit and credit and stuff like that. Debit in the accounting world is the left side. Credit is the right side. Debit left side, credit right side. That's as complex as it gets. And debits must also always equal credits when the dust settles. So when you think of debits and credits, what do you think of? Well, maybe you think of a debit card, a credit card, a credit being something you get back from a store, like you return something. We call that a credit, like a sale on credit. They refund something. It would be like a sales credit. A bank debit would be like a charge to your account. How am I doing with debits and credits? Anyway, we've heard the term before, and there's all kinds of applications to that. But in the accounting world, debit is left side, credit is right. There you go. So on a T account, here's assets equals liabilities plus owner's equity, left side, right side. On a T account, the left side is the debit side, the right side is the credit side. So we're just using the T to divide one from the other. We're going to put like the label of our account up on top, and then we're going to put transactions in there. I love T accounts because they've bailed me out many times. Okay, here you go. Kind of apply this photographic brainstorm. List 5 assets that a photographer would own. Estimate the value of each. Okay. By the way, don't just watch the video. Think with me, please. Pause the video. What do you think? Well, let me get rid of my paragraph. Remove space after paragraph. Let's see here. What would they own? Number one. In fact, I know a woman that has a photography business here in town. Here we go. Number one, what would they own? Well, obviously they're going to have a regular, and pardon me for not understanding photography, but they're going to have the basic camera, a digital camera, and pretty robust. If they're a professional photographer, what do you think that camera's worth? Let's say they're starting out. They're not going big time, but it should also be able to do video as well. All right. I'm thinking that a good digital camera for a photographer is going to be $3,000. You can argue with me on that. Okay, then you're going to have a bunch of different lenses. You're going to have like an high-speed action lens. The lenses are going to be like, I'm going to guess 300 to 500. Let's say that each lens is $500. You're going to have a regular portrait lens, 500. And then you're going to have a zoom lens. I'd say maybe 2 of those at, let's say 2 of those total is going to be like $600. 2 different levels of zoom. One's going to be like super detailed. One will be like zooming at like football games. All right. And then there's going to be some sort of tripods, $100. Maybe I even say tripods, monopods. Okay, I'm just guessing, all right? There you go. Estimate the value of each. Okay, so there's our photographer there. All right. And let's also say the photographer borrowed $3,000 from a friend. Ooh, what's that? That sounds like a liability. Label a T account for each of the above assets. Okay, well, how am I going to do that? Well, let's see. I'm going to pause for a second. Now I went to the liberty of creating these T accounts here. All right. And let's drop our numbers in. I got digital camera, $3,000. Increase side, left side. $500 from my action lens. $500 from my regular portrait lens. My zoom lenses, I'm just going to put as one category, 600. Tripod, 100. Okay, now we'll revisit that, begin on our liabilities and our owner's equity in there as well. There's my T accounts for my 5 assets for my photography business. Okay, moving along here. All right. Remind me to revisit that, please. So assets on the left side of the accounting equation is increase on the left or debit side of the account. So the natural balance side of the asset is the left side. We increase assets on the left side. Now, we've been practicing these plus and minuses. And so we have a feel for asset being increased, liability being increased, decreased, so on. Asset, the increased side is the left side, which is the debit side. Liabilities and owner's equity on the right side of the accounting equation. It's on the right side of the accounting equation. A equals L plus E, or capital, owner's equity. We kind of use those interchangeably. Personal net worth from chapter 1:1. All right. Increase on the right or credit side of the account. So if you want to increase a liability or increase owner's equity, like we did when we put money into the business or we recorded revenue, that's going to be recorded on the right side. The normal balance, the natural balance will be on the right side of the account for liabilities and owner's equity. Okay. The normal balance, the side of the account that is increased, is called the normal balance of the account. Sounds good to me. All right. Assets have normal debit balances. Liabilities and owner's equity or owner's capital have normal credit balances. Okay, we just said that before, right? And here we have it illustrated. Okay. Assets. Left side of the accounting equation up on top there. Assets equals liabilities plus owner's equity. The normal balance is on the debit side. A debit will increase an asset, cash goes up. A credit will decrease an asset, i.e., cash goes down. If we want to increase anything on the right side of the accounting equation, liabilities plus owner's equity, the credit is the normal balance, like a liability, like owner's equity. If we want to increase a liability, we're going to credit the liability. We now owe more money. And again, when we offset assets and liabilities, I think when we practice this, it'll make a whole lot more sense. Okay? But there you go with that. Owner's equity, same thing. If we want to increase, the normal balance is on the credit side for owner's equity. If we want to increase owner's equity, we credit it. If we want to decrease, we debit. Now, if our customer comes in and pays off their bill, right, we decrease the liability, we would debit or decrease the liability. That's a mouthful. That slide right there is one to master. Now, if you're like, pause right there and go, I have no idea what you're talking about, I'm so confused. Play it back again. Analyze this particular slide, this model, because it's going to guide you in entering transactions, whether it's increase or decreasing an asset, increase or decreasing a liability, and the same with owner's equity, or capital is what we're calling it here. All right. Key element right here on this slide. So the steps here: draw the accounting equation on a T account. Assets, left side, owners plus liabilities plus owner's equity, right side. What are the two accounting rules that explain increases of account balances? Well, assets are on the left side of the equation. Therefore, assets increase on the left or debit side of the account. Liabilities and owner's capital are on the right side. Therefore, liabilities and owner's equity increase on the right or credit side of the account. That's two pretty good rules. Assets, left side. Liabilities and owner's equity, right side. From the left side of the accounting equation, the normal balance is debit. From the right side of the accounting equation, the normal balance is credit. Throwing a bunch of stuff here at you. All right. Okay, let's go into our MindTap book. We need to pause this briefly to get into that. All right. And waiting, clicking, loading, all that good stuff. All right, here it comes. And there it is, week 6. Okay. We're going to go to Working Papers 2.1. And the Work Together. I got to change the scores on those, by the way. Those aren't correct. All right. And here we go. So cash. Increase side, debit. Decrease side, credit. Increase is a debit. Decrease is a credit. Normal balance for cash is the debit side, the left side. Again, debit means left, credit means right. Accounts receivable, it's an asset. The debit side is the increase side. The credit side is the decrease side. The normal balance is, because it's on the left side of the accounting equation as an asset, normal side is the debit side, normal balance. Supplies is an asset. The debit side is the increase side. Whoops, let's get that correct. Debit side is the increase side. And the credit side is the decrease side. Catching on there. Normal balance is debit because it's on the left side of the accounting equation. Prepaid insurance, another asset. Well, there's a lot of repetition here, Reardon. Yes, we have that. Yes. Debit side is the increase side. Credit side is the decrease side. The normal balance is a debit. It's on the left side of the accounting equation. Prepaid insurance is an asset. We will use it up over time. This is probably one of the more confusing ones here. Is it an asset or is it an expense? Depends on what months you match it in. We'll get into matching later. Accounts payable. Okay. Now it's on the right side of the accounting equation, liabilities. So the credit side is going to be our increase side. The right side, the credit side. The debit side is going to be our decrease side. It's on the right side of the accounting equation. It's a liability. The normal balance is a credit on the right side. Same with down here. Accounts payable, ocean supplies. The credit side is the increase side. If we add to our liabilities, we're going to credit our liabilities account. The debit side, if they were to like make a payment on account, the debit side will be the decrease side because it's on the right side of the accounting equation. The normal balance is credit. Finally, we have Parker Vogel Capital. It's on the right side of the accounting equation. The right side, credit, is the increase side. The left side, debit, is the decrease side. The normal balance is credit. I'm going to click on save and continue here. So you'll now work through the working papers on your own. Now I'm going to change these numbers up here so when you actually do them, they'll look a little bit different. Do the on your own on the working papers, just like we just practiced. Identifying increase, decrease side for assets, liabilities, and owner's equity. Make sure, of course, you do the terms review and then complete the application problem. All right. And there you go. And from there, there's going to be some other stuff you might want to check out in Google Classroom that will supplement our learning this week. But that's our lesson for Chapter 2.1 on T accounts. Take care.